The Bank of England has raised interest rates to 2.25%, the highest level since the 2008 financial crisis. It has also warned the UK could already be in recession.
For a moment there, it almost looked as if we could glimpse the light at the end of the economic tunnel. At the start of this year, the economy was bouncing back after COVID. People were spending again. Now, things are looking more worrying. With inflation now expected to be in double digits for months, the Bank of England have raised interest rates to the highest level since 2008. For those who run businesses, even those doing pretty well, the challenges seem to be coming from all angles, from the falling pound, which makes imports more expensive, to the cost of, well, everything else.
When inflation is a sort of a triple-edged sword, if you like, because you've got the impact on supply chain and the way that we bring goods into the business and trying to protect our customers from that, but absolutely the impact on demand because customers feel as though things are more important. Even if we're trying to protect them, our average price has only gone up by about 5%, but they'll be seeing prices rise everywhere, and therefore the propensity to buy is probably, it's more difficult to get them to come to make a big ticket item.
The bank actually thinks the UK is technically in recession now, though that's largely down to the impact of 2 extra bank holidays this year. The real question is what happens next.
We're already seeing signs that the economy is slowing from short-term indicators and that kind of thing. We're going to see more of that in the coming months, partly because of the interest rate rise and higher bills, but also because of the rise in the cost of living.
Now, in historical context, 2.25% isn't very high, and even 4.75%, which is where they're expected to go next year, doesn't look like much, especially compared to those double-digit levels in the 80s and the 90s. But don't be fooled, because these days households are much more indebted, their income's much lower compared with their mortgage repayments. Once you adjust for mortgage affordability, the red line here, those double-digit rates of the 1980s were actually equivalent to about 3% in today's housing market. Suddenly, 4.75% rates look quite scary. The last 2 times the red line hit those levels, we had a housing crash not long afterwards. Perhaps that explains why the bank didn't lift borrowing costs quite as much as some expected.
Now, it might sound strange to hear a 0.5 percentage point increase, the joint biggest that we've had since the 1990s, described as small, but actually there are a lot of people, including 3 members of the Monetary Policy Committee, who would rather it was even bigger, 0.75 percentage points. Why? Because on the other side of town in Westminster, the government is writing blank cheques financed by borrowing. That means more money sloshing around, and all else equal, you would expect an institution like the bank to act, and act fast.
For those with mortgages, that will mean higher costs. For savers, it's better news. But on top of everything else, inflation, energy bills, it all seems to point to a weaker economy. And the inescapable logic of higher inflation is that everyone gets squeezed at the same time. Businesses like Brooks Salon here in Telford, and her clients too.
I'm in a position where I need to raise my prices because I've hit VAT, but also now the electricity prices have gone up, and as well as my stock prices already going up 12%. Like, what am I meant to do as a business owner? Am I meant to just inflict that all onto my clients? Well, they're not going to pay that. I can tell you that now. They're not going to pay 57% on top of what they're already paying.
Economists love saying there's no such thing as a free lunch. But they've got a point, and it applies here. Even if the government succeeds in boosting economic growth, there is a sting in the tail. Higher interest rates. Potentially much higher. Ed Conway, Sky News.